If you're like me, you probably spend several hours, hey, maybe even 30 of them this past weekend, watching football. Despite having to overcome sub-zero temperatures in Kansas City, where I was Friday and Saturday, and a blizzard in Buffalo that caused a 24-hour delay for the Bills-Steelers matchup, the weekend was an unmitigated success for the NFL. Hey, we know that our parent company, Comcast, is happy. The Chiefs-Dolphins game on Saturday drew an average audience of roughly 23 million viewers on the Peacock, making it the largest live stream event in U.S. history. I work for Comcast, but I don't mind hitting that button. Wags were expecting much lower numbers, and games on traditional networks all did well, too. The NBC games on Saturday and Sunday, they earned average audiences of 29 and 36 million viewers, respectively. Fox's Sunday game between the Packers and the Cowboys drew a reported 40 million viewers. Wow. Long story short, the ratings of all these playoff games were huge. There's a tremendous level of interest in the NFL right now, and with 4 great matchups coming up next weekend, I bet it continues. Of course, when I see a trend like this, my first thought is, all right, how do we profit from it? Sure, the media companies broadcasting each game are winners, but they also pay a fortune to the NFL to get the right. It's not as clear cut. Wait a second. Instead, I want to recommend DraftKings, which has emerged from a couple of years of intense competition as the market share leader in online sports betting. This stock was one of the biggest winners last year. It was up 209%, but it stalled out in December and has pulled back over the past couple of weeks. But when DraftKings pulls back, just as the NFL playoffs are racking up major ratings, well, guess what? Buy. That's right. You're getting a great buying opportunity for DraftKings. Now, remember, the first pillar of the DraftKings bull thesis is simple. They've already won. They're the leader in online sports betting, roughly 5 years since the Supreme Court legalized the practice. At first, it looked like FanDuel and DraftKings were emerging as double winners. But last year, DraftKings surpassed them in market share, and right now they got a lot more momentum. They have a fantastic daily fantasy business that makes watching even blowout fourth quarters interesting. Good synergy with the networks there, by the way. In short, DraftKings is a last-man standing story, like Uber and rideshare or DoorDash and food delivery. Now that the battle for market share is over, and the whole industry is more focused on boosting profitability, these companies can spend far less on marketing, advertising, and incentives to pull in new users. Sure enough, DraftKings is operating much more profitably than it used to. This is pretty amazing. See, the company achieved its first quarter of positive earnings before interest, taxes, depreciation, and amortization in the second quarter of last year. Though that number turned negative again in the next quarter for 2023, they should have an EBITDA loss of 95 to 115 million. Put that in perspective. When DraftKings first gave you an EBITDA forecast for 2023, they originally were projecting $475 to $575 million in losses. So last year turned out to be a lot better than expected, and that's what matters. More important, when the company reported its third quarter results in November, it also rolled out its full year 2024 forecast, and that included an EBITDA target of positive 350 million to 450 million. I love to get involved in these situations when a company's moving from unprofitability to profitability because the dynamics of the industry have changed. And the DraftKings textbook example. In terms of earnings per share, the analysts expect that to turn positive next year. That is going to be something you've got to be in ahead of. Now, even though DraftKings has pivoted to profitability, they're still racking up terrific revenue growth. In the first 3 quarters of 2023, they had 84%, 88%, and 57% revenue growth, respectively. Wall Street expects them to do 48% when we see their fourth quarter numbers. Also, worth noting, the company's beaten revenue expectations for 8 straight quarters at this point. So don't be surprised if the actual fourth quarter number is a lot higher than 48%. One thing you need to remember, DraftKings has been growing like crazy, despite the fact that it can't do business in California or Texas, because they haven't legalized sports betting, and the numbers so far don't include Florida either, because sports betting only it became legal there in December. See, Florida's weird because the rights to this business all belong to the Seminole tribe and its partners. So I have no idea if or how DraftKings can thread that needle. But if California or Texas ever made it legal, and a lot of other states still haven't legalized it, DraftKings should get a major boost. On top of everything else, you need to keep in mind that this stock tends to do well during the NFL postseason. Out of curiosity, we went back to check to see how DraftKings performed from the new year until just before the Super Bowl in each of the past 3 years. And in 2 of the 3 years, it's been a great stock dome. Got a 37% rally 2021, 40% rally 2023. All right, in 2022, the stock got hit with a 15% sell-off. Don't forget, though, January 2022 was that was a total time for any stock and every stock. Okay, it was particularly unprofitable stocks like this one. Granted, it's a small sample size, but 2 out of 3 ain't bad. Overall, it sure looks like DraftKings is a solid bet during the NFL postseason, averaging a 21% gain over this period over the last 3 years. I wouldn't necessarily expect such a large move again because this is now a larger company. But let's just say the trend is your friend. Look, I've liked DraftKings for a while, and I've been right. This was a difficult story when the sports betting industry was getting flooded with infinite money from venture capital firms. following everybody in the business to advertise. It made everyone advertise like crazy and promote the heck out of their services. But that money dried up a while ago. And now DraftKings has emerged as the online sports betting champion at a time when they can finally get away with cutting costs because everybody else is doing it too. So let me give you the bottom line on this fascinating story. Now that DraftKings has pulled back a bit from its highs over the past month and a half, and after we saw the incredible public interest in the first weekend of the NFL playoffs, I am feeling like you're getting this terrific buying opportunity in the stock. If you don't already own the stock of DraftKings, you should consider adding a position, especially for the next couple of weeks, as seemingly the whole country's watching the NFL. Let's go to Blake in Tennessee. Blake.
Hey, booyah, Jimmy Chill, from a very happy club member who is looking forward to seeing what you, Jeff, and the team have set up for the next monthly meeting.
Well, we're going to have a good time. I just was kicking back and forth some notes with Jeff this very weekend about the meeting. What's going on?
Hey, Jim, I did some homework on this company that I actually heard you mention this morning. It's a leader in their field, and Synopsys has had a nice pullback and what looks to be a great long-term chart. What do you think about Synopsys, especially with their...
this merger, they're not paying a lot for it. I'm telling you point blank, I like Cadence, but I'm starting to like this one more. I think this merger is terrific. Synopsys should be bought even up here. Great call. And thank you for being a club member. That's terrific. We had a really good time with Tony Dungy and Rodney Harris this weekend talking about the club. They are very, very supportive. How about Nathan in my daughter's old home state of Oregon? Nathan.
Hey, Jim. How are you?
I am doing well, Nathan. What are you up to?
So, first-time caller and member of the investment club.
Thank you.
First of all, I want to thank you for all your advice.
Thank you.
On your recommendation, I bought Workday in 2018 and held on through all of its volatility. It has doubled since that time, and it's hit its 52-week high today and is close to its all-time high. Should I continue to maintain this position, trim or sell? Thank you.
Oh, no, we're holding this position. It's breaking out here. Now, look, all of these enterprise software companies could have a pullback, and I understand that. But this company is so well run. It's probably, along with ServiceNow and Salesforce, my three favorites in the enterprise software group. It's terrific. Let's go to Greg. Thank you for being a member of the club. Gregory in California. Gregory.
Hey, Jim, another member of the club here.
Oh, my God.
And I'm proud to say that. And listen, on a down day like today, I'm looking at this company that I want to chat with you about, to get your thoughts on, in the cybersecurity area, which it hasn't got to like the frothy levels of the club holding Palo Alto Networks, CrowdStrike, and others in the space. But I just can't see why old school company like Checkpoint shouldn't have a 2 in front of its stock price. Am I wrong here? And
no, you're not. I think you're absolutely right. I'm surprised that the PE is so reasonable. You're absolutely right. We did nail Palo Alto Networks, which is probably one of the greatest performing stocks of our time. Checkpoint cannot do as well as Palo Alto. We watch Nikesh Arora today. He's just got so much momentum. He's the CEO of Palo Alto. But I do think you're right. The Checkpoint's good. And I want to thank all three people who joined the club. And I think you should join the club, too. All right, now, listen, I've been a big fan of DraftKings for a while now. And its recent pullback has given me a great buying opportunity, given all the interest surrounding the NFL playoffs, particularly because the daily fantasy where the action is. Much more made money ahead after being after being out at the JP Morgan Healthcare Conference. I found that there's some newfound enthusiasm for the healthcare cohort in general. I'm going to reveal 5 of my favorite names for 2024, so get your pad and pen out. Then I'm sick of all the endless chatter about when the Fed will cut rates, so I'm revealing 6 reasons why I believe those analysts have no idea what the heck they're talking about when they say it. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round, so stay with Cramer.